Sri, one of the topics that's always been debated over the last couple of months is whether the bond market or the stock market is predicting where the economy is going to go, i.e. is it going to recover the economy or is it going to collapse? Where do you stand on that?
I think the bond market has been consistently a better indicator, Wilf, and we saw that before the 2001 recession, we saw that before the Great Recession in 2007, and it is no different this time. And in terms of what has been happening here, look at what happened when the Dow was up 500 points earlier in the day. The 10-year Treasury yield was down. So if you believed the bond market rather than the equity market, you would at least have had a few hours notice in terms of what was coming. Let me go a step further. What is the bond market reacting to? Not only my home state of California, that, as Sarah said, is 15% of US GDP, we have seen, and I've seen myself, restaurants in the neighborhood have been shutting down even before our governor decreed it today. So that has been taking place for quite some time. The attendance is low. And a very important point today, Texas governor shuts down bars and restaurants for the second time. Well, the shutting down for a second time is crucially important, and I'll tell you why. Because once you believe that it's a temporary phenomenon, you shut it down in the expectation you're going to open your restaurant a month or 2 months later. If a second shutdown happens, the story we have is they decide then to go away from that business altogether. And small businesses are 44% of US economic activity, and they are closing like crazy all over the world, all over the country. Expect that more to happen in the case of Texas and Florida, and also more and more in California. The education system, whatever the president may wish, we in the Los Angeles school district, the second largest in the country, we are not going to open anytime soon. San Diego is not going to open anytime soon for persons to attend school. Sarah, the last point I would add to it is the New York City mayor pointing out that there has been a troublesome increase in incidents in the 20 to 29-year-olds. This is a new development. That, again, is something which will effectively have an impact on the stock market, which would probably be late in reacting to it like usual. But the bond market is going to react faster, Sarah.
My only argument with that argument about who's right, stocks or bonds, how can either of them be right, Sri? Because they're both pretty distorted by the Federal Reserve right now, which has been an active player, certainly in the bond market, and also with the increase in its balance sheet, propelling the stock market as well. So isn't it hard to get any sort of straight-up economic message from either?
You are spot on. You make a very good point, and I'm not going to be the person to say that the bond market is pure indicator and the equity market is not. But what has happened, despite all of the point about quantitative easing, recall that 4 years ago, people started to look for the 10-year Treasury yield to increase. The story hasn't changed. We have increased quantitative easing so many, a multiple in the last few months. But the people started to look for lower bond yields even earlier when quantitative easing was in effect. The problem is to try to decide and to distinguish what portion of it is due to Fed action and how much of that is to expectation of slower growth and low inflation rates. And I believe that the latter economic fundamentals are more important for the bond market, Sarah, than they have been for equities.